Undervalued, a healthy balance sheet, and a strong dividend are three things that I really like to look out for when I'm looking at different stocks. Now, the problem is usually you find one or two of those three within one stock, but very rarely do you see one that has all three. However, the company we're looking at today has all three of those, as well as just increased their dividend and their guidance for the next fiscal year. So let's go ahead and talk about DR Horton. Hey everyone, thanks for joining me today. My name is Matt, and as I mentioned in the intro, today we're going to take a look at DR Horton. Before we do that though, I just have to say, not advice, please don't take this as advice. If you do need advice, please speak to a financial advisor and make sure they're a fiduciary, but everything I say here is just for your entertainment purposes only. Now, if you're not familiar with DR Horton, they are a home builder in the United States. They're actually the largest home builder in the United States based on the number of closed home sales they have each year. They operate in 90 markets across 29 states in the US, so not in every state, but they have a very large presence. And DR Horton does have a few branches underneath them that really helps them reach a variety of different clients, but their core business is built around either first-time home buyers or people that are looking for their first upgrade from their first home, so really like a second home purchase. So DR Horton is mostly focused themselves on the kind of that second level, mid-level home buying process, and underneath that they have Express Homes, which is guided or focused more towards your first-time home buyers, so those homes are going to be at a little bit lower of a price. Then they have Freedom Homes, which is more of a modular style, so a little bit cheaper than what you'll see with Express Homes, also though focused on the first-time home buyer experience. And lastly, they have Emerald. Now, Emerald is their luxury home business, and it is by far the smallest portion of their business, and it's worth noting that DR Horton and Express Homes actually make up about 96% of the total revenue. So Freedom and Emerald are very small branches, but nonetheless are still underneath the name for DR Horton. I'm trying to be more cognizant with the length of my videos, so without wasting any time, we're just going to jump right into the numbers here today. Now you'll see we'll be comparing DR Horton's numbers to Pulte as well as Lennar Homes. Reason being is because those are both pretty tough competitors for DR Horton, and I'm not saying that either of these really are better or worse than each other. They're all very promising companies, but you'll see a little bit later why I'm putting my focus towards DR Horton. So as we can see, the PE non-GAAP forward ratios really ranges between that 9.1 to 10.27. So these are all fairly low when it comes to their price to their earnings, and it's kind of refreshing to see. You know, it gets a little tiring after trying to figure out if it's a good buying opportunity for a company that has a PE ratio over 100 or over 80. So I like, for once, we finally have some companies that are potentially undervalued. But as we could see, with that undervalue or potential undervalue does come a higher beta. And yes, this beta is a little bit higher than what I typically enjoy investing in. I like that 0.8 to maybe 1.2 because, I mean, I don't mind volatility, especially with having such a long outlook, but there is always that little unsettling feeling when you see a company with, you know, over that 1.5 beta compared to the market's performance. Earnings per share. This is a really good earnings per share to see, and I was actually surprised about that. You know, Lennar Homes, very impressive at 7.16, but even Pulte at 4.78 is not a bad earnings per share to see at all. You know, sometimes we're looking at companies with negative earnings per share or, you know, non-existent earnings per share. So again, to see that they have an earnings per share is great, but the fact that they're all over 4 is even better. Now, the revenue growth year over year, this is one of the reasons why I like DR Horton, because they've been doing a really good job growing their revenue. With it being 11%, it's substantially higher than its two competitors are doing, which again is something I like seeing because to me, I view that as a way that they are finding new opportunities in new markets to keep expanding their business and potentially are becoming more cost efficient when it comes to building these homes. Net income margin, again, relatively the same here, but as we can see, this is actually where Pulte shines a little bit because they have the highest net income margin. But really for home builders, I'm okay with any of these net income margins. So again, nothing really worth losing sleep over when it comes to even a 9.97 net income margin. That's a great thing to see. The payout ratio. Now this I thought was a little weird. Payout ratios are usually pretty high. I think we've even seen payout ratios that are upwards of like 75% sometimes with certain companies. So seeing this down in the 10% was a little strange, 10 to 13%. But since it's consistent across the board, and this is one of the reasons why I always like or try to compare it to competitors, because it just gives me an idea for what the industry looks like. And remember, numbers aren't the same just across every industry. So that's where it just helps you when you're trying to learn these companies and see which one maybe has an advantage to look at its competitors as well, because that'll really help give you a guideline or a base for what you should be shooting for with this company as an investment. Now, another reason why I like DR Horton though is because of this dividend growth. 22.5% over 3 years compounded annual growth rate is what it is, or CAGR, is very impressive, especially looking at Lennar, who's a 0.59. So DR Horton has made a pretty strong emphasis on giving back to their shareholders. One of the way is increasing their dividend, but they are also in the process of doing share buybacks in current ratio. Now, Lennar with a 12.04. I guess that makes sense why their dividend growth is pretty low, even though their payout ratio is the highest, because they probably keep a lot more cash on hand than the other two do. And I also know Lennar, I said this before, but when Lennar builds homes for neighborhoods, they really just start building before anybody's really even purchased one of those homes. Where I know for DR Horton, they don't actually build the homes until somebody says, I want this home on this lot, this model, this color, countertops, cabinets, all of that good stuff. So it makes sense for Lennar to need to keep a little bit more cash on hand in case there's a month where they have all these homes being built, but not as many people buying those homes. Now, one of the reasons though why I'm looking at DR Horton for this week is because they did report earnings yesterday. And their earnings report is what every shareholder should look for. There's a few things that were a little off, but that's okay because the rest of the report just shattered analyst expectations, as well as beat even their own guidance that they gave for this quarter. So that got me really excited, and again, that's probably the main reason why I'm looking at them this week. I've held off on home builders, but after hearing this report, it just sounds like such a good opportunity. Now, again, there was a lot of things that I really liked from the earnings report, but I'm just going to give a few highlights, and I'll leave a link below for the actual report itself if you wanted to look at these numbers for yourself and compare either the year, quarters, whatever. And just, all these numbers are going to be a comparison to last year, not last quarter. So the amount of homes that they closed increased by 15% compared to last year, bringing that to around 65,388 homes closed this year. On top of that, the value of the homes increased by 16%, bringing that to around $19.6 billion worth of homes closed. Real quickly, if you're wondering the difference between closed and sold, so sold means that somebody bought the house and they went through the process, but they might have not actually gone to the closing table, so something might have fallen through during the due diligence period, maybe issues with financing or anything like that. Closed means the keys were handed over and that person actually moved into the house. Their consolidated revenue, basically meaning the revenue from all of their branches, as well as they have lender opportunities or mortgage things that they receive money from, notes receivable, all of that, was increased 15% to $20.3 billion, which also allowed for them to increase their dividend by 14%. Now, I know earlier I said a great dividend. It's 20 cents a share, so it's not really the best dividend in the world, but seeing at how much they're growing that dividend, it's a good thing to see because that dividend should increase over time as this company still continues to perform very well. And also, they increased their guidance for the next fiscal year, which is a bold move because obviously right now you could say we're in very uncertain times. Sure, things are maybe looking a little bit clearer now that, if you think the election is going to have an effect on the economy. So things might look a little clearer, which maybe gave them the little bit more confidence in increasing their guidance. But regardless, when a company increases their guidance, it means that they have a very strong expectation that the company will do well during the next year. And they increased their guidance last year at this time for this year, and they still exceeded what they anticipated doing. So if DR Horton is able to keep these increasing numbers, they should be an even more powerful company than they are right now. So all that's very exciting. And, it's kind of like, what's the catch? This sounds almost too good to be true, and maybe it is, but I don't think it is. Because I would think for a company like this, you would be paying a premium. Now, as we saw with the PE ratio, these companies are not trading at a premium at all. And you can't really use just a PE ratio to determine a value of a company. PE is kind of like the weakest ratio of them all, if I'm being honest, because it can really easily be manipulated by management. But even taking a look at Simply Wall Street's discounted cash flow to equity, or they use free cash flow to equity, sorry for this one, we can see that it's actually showing them being around 43.6% undervalued, which is crazy to think. But I think it's because there's always a little bit of apprehension when it comes to investing in home builders, because I think the '08 housing crisis is still very fresh in a lot of our minds. And so it makes sense for the lower pricing of these shares for these home building companies. But actually, with these companies being undervalued using this valuation method, it's actually a really common theme across the board for them. You'll see very similar numbers between, I'm just looking here for myself, Pulte Group as well as Lennar. So that's something we actually see pretty consistent. Now, 43% undervalued means that this company has a lot of potential to grow. Growing while paying a dividend is a great thing for me to see as well. And that's exactly what I'm looking for, because ultimately, with having such a long time horizon, most of the time I do prefer growth than I do income, depending on exactly what my savings objective is. But like in a retirement account, income's okay, but I like the growth aspect of it. And if this company can go from $70 a share to $125 a share, giving us a $55 gain a share would be insane. And that's definitely something I want to be able to take advantage of. But there's also another reason that this gets me excited. And maybe this doesn't have as much to do with this stock as it does the economy. And reason being is because home building and home sales, depending on which source you look at, but from my Series 7, home building and home sales are two of the top 10 leading indicators of the economy. Meaning that usually when home building is up, it's a good indicator that the economy will perform well. If home building starts to decrease or takes a substantial decrease, then that might be a sign that the economy isn't doing well. Now, you can say that interest rates environments right now allow for people to buy bigger, better homes at basically a lower cost, and that is true as well. But the fact of the matter is people are still confident taking out a 30-year mortgage right now to build a new house. So seeing that D.R. Horton is able to increase the amount of homes that they are actually closing, to me means that there's a lot of optimism in our future economy. So for that reason, makes me a little bit more confident in our economy as well, seeing these home builders all of them really are increasing their home sales. And for that, we're gonna add this to the portfolio. All right, so I went ahead and did buy 100 shares of D.R. Horton, which admittedly does sound a little aggressive, but it's one that I've wanted to buy. I've been keeping an eye on for a while, and I really feel like now's a good opportunity. Also, given the valuation of this stock to me still has a lot of runway, which could be a really good thing for us to have in this portfolio. So we have 100 shares, down $6. Seems to be a reoccurring trend with Webull, where when we buy these stocks, they always seem to take a hit, unlike E-Trade, where they always seem to go up, but that's okay. So only down $6, nothing worth losing sleep over. Etsy still blows my mind. I don't get why this company had a really good earnings call and everything that I was looking for, but it's down $640 for us. So maybe it'll rally back someday. I'm not going to sell it right now while it's down, but we'll just keep an eye on it and see which way Etsy continues to go. As for the other two, ArcQ up around $106, which is good, and ChargePoint around $36. That one's finally positive as well. So things are finally starting to turn around in this portfolio. We had a few losers in there for a while, but I think we're in good shape. And now I think with D.R. Horton, we should really start to see this portfolio grow a little bit quicker. So I'm hopeful. Hopefully you guys like this as well. And as I mentioned, I'm trying to keep these videos shorter, which means I do have to sacrifice some details. So please let me know in the comments below if you have any questions about this stock. If there's anything you think I missed or anything you want me to clarify, let me know and I'll happily address them and discuss that with you in the comment section. Now, if you like this, hope you hit it with a thumbs up. And if you wanted to subscribe, please feel free to do so. I always like it, as I always say, love seeing the subscriber growth, and because to me it just makes it or reassures that I'm actually giving valuable information. So if you haven't subscribed already, I just hope that you consider doing so. That said, not sure if it's going to rain today or if it's going to be nice. It looks super sunny right now, so I'm going to wrap up here. Thank you so much for taking the time out of your day to watch this video. You could be anywhere in the world and you're right here with me, and I really appreciate that. But I'll let you go ahead, enjoy the rest of your day, and I'll see you next time.